I've got my 6-year-old daughter's soccer ball. And this first bit of the presentation, I'm talking about the U.S. labor market, and this this phrase I'm using here is depressurizing, not deflating. So think of the U.S. labor market as like a soccer ball, in this case, or a basketball that's extremely high pressure. It's very hard. It's been pumped with too much air. And right now, policymakers at the Federal Reserve, CEOs, leading major companies, and our political leaders in Washington are trying to depressurize the U.S. labor market. And what the goal is it's not to deflate the soccer ball. It's just to let out a little bit of pressure, a little bit of air to make it more usable, less hard, less at risk of an errant shot, so to speak, if you're going to use the soccer analogy. So let's talk about depressurizing, how the U.S. labor market is depressurizing. So the story of how we got to here is based on strong labor demand. It's based on employers voracious in their appetite to hire workers. So here we see broad-based demand to hire workers across every major industry. This is job openings through April of this year compared to February of 2020. That is basically the last 26 months since the pandemic started. We've seen now manufacturing have more than double the job openings than it had pre-pandemic. And if you remember 2019 or early 2020, that was a really strong labor market, even then. Go on down the line here. Transportation and warehousing, also more than double. Leisure and hospitality, more than almost 60% compared to early 2020. And on down the line, we see very strong broad-based demand. And then on the other side, in terms of labor supply, we see that labor supply is recovering. This chart here, I'm showing prime age labor force participation rates over time and how they've begun to, especially in the last 6 to 9 months, really tick back up. And not to be ageist, but I always emphasize this prime age cohort of 25 to 54-year-olds. These are workers or potential workers who are not at or near retirement age, as well as not in their early 20s and maybe out of the labor force because of higher education. So this prime age cohort is almost, but not quite, at the same labor force participation rate as they were pre-pandemic, which was a little above 83%. Now, labor force participation means that you either have a job, you're employed, or you're actively searching for work in the last 4 weeks. And so this is encouraging. So the labor supply is almost back to where it was, but it's just being swamped by the labor demand that's just so far and above, almost 60% above the pre-pandemic level in terms of job openings. And so that job openings figure that I showed you in the first slide by industry, here it's in the orange line, and we see job openings over 11 million of them in the U.S. And so this is the kind of fundamental mismatch, the chart that I always go back to of how labor demand, the job openings, exceeds labor supply, where in the blue line, the pool of unemployed workers is now below 6 million. So that gap, it's almost 2 to 1. Almost 2 job openings are currently in the U.S. labor market for every 1 unemployed individual. So that is the source of this high pressure, overinflated soccer ball of the U.S. labor market. It's very, very high pressure. And so what is the Fed's goal? What are our political leaders' goal to kind of reach a new equilibrium, to depressurize? As I use that phrase, depressurize, but not deflate. That's the goal. And when I talk about that, I talk about the Federal Reserve's goal in particular. It wants to cool off demand, not just consumer demand in terms of spending, or the real estate market in terms of housing prices, or business investment. The Fed wants to cool off labor demand in particular. It wants to lower the number of those job openings or vacancies that I showed you in the previous chart. And so this chart here is the ratio of those 2 lines I previously showed, right? I showed how there's 11.4 million job openings and less than 6 million unemployed persons. Well, this is the ratio of unemployed people per job opening. And so the target the Fed wants to have is around 1. That's that dashed line here. It wants to let out a little bit of the pressure. Anytime the labor market gets below that 1 line in terms of the ratio, it's too much pressure in the labor market, and it can fuel wage growth, it can fuel inflation potentially. So the Fed's goal in raising interest rates, which we're going to talk a lot about later today, in terms of slowing down the U.S. economy that's red hot, the goal is to depressurize, to lower the number of job vacancies, but not to deflate the labor market. That would mean rising unemployment. The Fed doesn't want rising unemployment. We want strong hiring, we want strong employment demand, but we want to maybe lower the number of open positions, vacancies that employers are trying to fill. So that's the essence of the depressurize goal.